Mortgage rates are heading towards 6% interest, hundreds of mortgage products were pulled from the market, and millions of people are set to face rocketing bills as the bank's base rate is set to triple, which could add more than $13 billion to mortgage bills by the end of next year. Homeowners who are able to borrow more because of low interest rates are in trouble. First-time buyers are left feeling totally lost, and when the leading money expert in the country says this:
regulator, Bank of England, government, you need a mortgage emergency plan now, or there's a ticking time bomb.
We know we're in trouble. Lenders like Barclays, NatWest, Nationwide and Skipton are now putting their mortgage products back on the market with rates of almost 6% after the announcement of the Chancellor's mini budget, which sent bond yields soaring. The average mortgage rate has jumped at 1%, making them their highest level since December 2008, when they were 5.8%. Many lenders have had to withdraw mortgages for new customers because of the sharp rise in government bonds, which are used to price fixed rate mortgages. Many banks are still waiting for the markets to settle before putting their products back on. It's safe to say it's not good. So how did we end up in this mess? And what does this mean for homeowners, first-time buyers, renters, and what can we do about it? Essentially, it's because of inflation. Inflation, as of today, is hovering around 10%, which is not good. Inflation is how much the cost of goods have gone up each year, meaning that things will be 10% more expensive year on year. Inflation getting too high is not good and can lead to currency spiraling out of control and your money becoming worthless. The pound takes a huge hit, driving the price down. The rapid increase in the cost of living is mostly in part to Russia's invasion of Ukraine, which has led to higher bills and energy, an increase in the price of foods and other goods, and unfortunately inflation hits the least well off the hardest. When inflation gets too high, the Bank of England steps in to try and keep it under control. A tool for doing this is increasing the base interest rate. The base interest rate is the rate the banks charge to loan each other money, and it's technically called the bank rate, which influences all of the UK rates, loans, mortgages and savings. So while you may get a better saving rate and dreaming of the days of the return of the 5% cash ISA, high mortgage rates also go alongside it. Great if you don't need a mortgage, not good if you do. The Bank of England raised their rates from just 0.1 in December to 2.25% today, and the Bank of England has to continue to raise this in order to keep inflation under control. Essentially, when you pay your mortgage rate, you are actually paying the bank rate plus the interest rate charged by the bank on top of this, which may be the same as it was previously, but I suspect in some cases they'll also take the chance to increase that rate on top of it to reflect the uncertainty in the market. Although that's not for certain, as they do still need people to be able to afford their mortgages. The Bank of England has a target rate of 2% inflation, and it's currently at 9.9%.
Yeah, I'm going right to the top.
But this increase should hopefully help bring things back to normality, which is a strange thing to get your head around, but I'll talk a little bit more about that later. When we look at the scale of what's happened, we can see just how much mortgage rates have risen this year. Just from December 2021, both 2 and 5 year mortgages have jumped from the 2 to 2.5% range to 4.5% in September this year. And with the craziness of the latest updates, those rates are now at 5.5% and on their way up to 6%, which is almost triple what it was at the end of last year. Might leave you feeling like a rock star if you locked in a 5 or 10 year mortgage last year, but certainly not great news for the rest of us. And even if you did lock in, you may be facing the same problem when you come to remortgage. If we take a look at how those percentages translate into real numbers, this is where it gets scary. Here's how the numbers scale on 4 different amounts borrowed based on a 25-year repayment mortgage: 100, 200, 300 and 400k. Here's those figures at 2% interest, and here is those numbers at 4%. We can see how much the price has gone up by 104, 207, 311 and 414 pounds, which is a lot as it is. But when you increase those numbers to 6%, this is where it gets scary. A 220, 441, 661 and an £882 increase per month, which is just insane. What's really frustrating about this, even more so than the price, is the fact we weren't taught any of this in school. I'm pretty sure that basic knowledge of how the mortgage system works would have been far more beneficial than working out the area of a triangle, especially with the younger generation now who are having to pay these astronomically high prices for houses and have been able to borrow at insanely low rates. The base interest rates since 2008 have been so low low that a regular person would have no idea how high the rates have been in the past. 15% in 1990. Just imagine that rate in today's market. One of the biggest misconceptions is that house prices were so cheap back then, and the other way around is that mortgage rates are so low now. And what I'm about to show you may surprise you. When you actually crunch the numbers, this is what you see. Here's the interest rate in blue, and we can see how this has decreased over time. But when you adjust it for affordability, taking into account things like current mortgage terms, rates and living costs, you can see we're actually much closer to the high costs of the 1980s than you might think. It does make you question whether there's a huge gap in affordability checks now. In 2008, the market crashed partly because people borrowed way too much money, way more than they could afford, without proper affordability checks. And while today there's far better checks in place before you're able to get a mortgage, I question how well that affordability knowledge is presented. When you apply for a mortgage, you generally have a very lengthy phone call, and one question in there is, could you afford your mortgage if it went up 1%? At this point, you're probably pretty fed up with a phone call and just trying to get it done with. But where's the real numbers that show you what happens if it goes up 6% or even 10%? I feel like there needs to be a much clearer understanding for people of just how this works and how expensive it could get. There's just under 9 million residential mortgages in the UK, 75% of which are on a fixed rate. And according to statistics, 1.3 million of those deals were due to end this year. And if you haven't sorted out a new product yet, you may be in for a shock. I know this is a difficult time for everyone, me included, so here's what I think your best options are going forward. And the last one may shock you. The first thing to do is not bury your head in the sand. While ignoring it and waiting until it becomes a problem may sound easy, it'll bite you in the long run. A lot of people are in the same position right now, and if you think affordability could become an issue, speak to your mortgage lender. Remember, they want you to continue making your payments and can work with you to find a solution. They may be more generous because of the current climate and allow you to extend your term. And bear in mind, even if extending your term isn't something you wanted to do over the long term, you can extend it for a few years and then reassess your situation in 2 or 5 years time. And then you could look at shortening your term back to your original goals. Secondly, if you're looking to buy a new home right now, it's tough. People who have already applied for their mortgage, their terms should still be honoured. But before you go ahead, you may need to reassess and think about affordability. There's a good chance that these rates won't be temporary, and when you come to remortgage in a couple of years' time, they may still be high or even higher. Third, if you want a mortgage, it's likely a good idea to get one and lock in ASAP. There's still what looks to be some reasonable deals around. After a quick scan on Money Saving Expert, there's a few deals around 2.25%, which surprised me. My mortgage 5 years ago was 2.6%. There's no guarantee that they'll honour these deals, but worth talking to them to see if you can lock in ASAP. Fourth, it may be worth considering if you can remortgage now to secure a deal before rates go up even higher. But if you do this, you need to take into account early repayment charges, and some mortgages will charge you thousands to do so. If you speak to your provider, they may actually be willing to waive this if you're a mortgage with them and secure for a longer period. 6, you could consider switching to an interest-only mortgage, which I don't particularly like as I want to repay the capital, but it would drastically reduce your payments. Although remember that interest, unless it's fixed, will scale with the bank rate. 7, if you're a first-time buyer, you need to be aware of negative equity. That's if house prices drop more than the equity you have in your property, which will leave you in the red. I know a few people that this happened to, but over time, remember, house prices go up. Even the people I know who bought right before the 2008 crash got their money back and then some. If you're worried about house prices, then remember house prices scale. Being on the ladder is almost the most important part. If your house goes down in value, then so do the other houses on the market. For example, if you bought a 100k house and it went up 10%, you've made 10k. Yes, the 300k house you've been eyeing up to move to may have gone up to 330, but that's only a 20k gap. If you didn't have your house, it would be a 30k gap. And also remember, you need somewhere to live. If you have an alternative living arrangement, perhaps it's best to do that and just save, like living with parents. But otherwise, the alternative is to rent. Rent prices will also increase as their mortgage payments will too, unless they're kind enough to stomach the cost for you. 9. Hustle. I know I say this a lot, but a side hustle that brings you in an extra few £100s per month is really a no-brainer. And this period may finally give you the motivation to get going. I'll have more on those coming soon, so stay tuned. And lastly, number 10, which I think may really surprise you to hear me saying this, but I think it's actually very sensible, is to pay off your mortgage and stop investing.
What?
Now, typically people will tell you that keeping a big mortgage on a low interest rate is a good thing, and you can make more from investing. Well, yes, that's true, if your returns outweigh your mortgage costs. But what if they don't? Let's say I had a 300k mortgage at 5%. That's 15,000 per year interest. My ISA's 100,000, not realistic for a normal person, but even me, I need to make over a 15% return this year to make it more worthwhile investing. Now, considering the S&P 500 is down almost 22% this year, it's not looking likely. That argument does change though over time as your money compounds. Then investing over a mortgage becomes a no-brainer. But as much as people may look down on it, overpaying your mortgage and putting yourself in a comfortable position where you aren't struggling is a very good idea. Investing is all good and well, but having a life full of stress because you're struggling to meet your mortgage repayments isn't worth it. A friend of mine has paid off his 300k mortgage now and has just started investing. No mortgage bills to worry about. Yes, he's mid to late 30s and may be considered too late to the party, but now he can put all of his money into investments. And he's not bothered at all about interest rates. In fact, he wants them to go up so he can save more in the bank. Not the approach I've taken, but it does sound quite appealing. Let me know what you think about this down below and what you're doing in the current climate. And before you go, make sure to also check out this video as I think you'll find it really useful. And as always, stay safe in these rocky times and thank you for watching.